Have you ever just wondered why the interest rate on your home loan suddenly goes up or down? Or why the returns on your fixed deposits seem to change out of nowhere? Well, it's definitely not random. See, there's a really powerful institution behind the scenes, pulling all the levers. That's the Reserve Bank of India. And today, we're going to peek inside its toolkit. So here's our game plan. We're going to start by getting to know this financial guardian. Then we'll dive into the main tools it uses every day. After that, we'll look at the emergency measures for when things get tricky. We'll also cover the fundamental rules all banks have to live by. And finally, the most important part, we'll connect all of this directly to your money. All right, first up, who or what exactly is this guardian of our economy? Let's get a clear picture of what the RBI is all about. The easiest way to think about the RBI is as the manager of Team India's economy. Its main goal isn't to make a profit. Nope, it's to keep our financial system stable, keep inflation in check, and make sure the economy is growing at a healthy, steady pace. It's a really delicate balancing act, and its decisions affect every single one of us. Now, the main way the RBI pulls this off is through something called monetary policy. It sounds complicated, but it's really just the formal name for the RBI's toolkit. It's the set of tools it uses to control how much money is flowing around in the economy, always trying to find that sweet spot between stable prices and economic growth. So how does the RBI actually use this toolkit? Let's start with the two main levers it pulls all the time. These are the go-to tools for influencing the economy day in and day out. Okay, think of these two as the gas and brake pedals for the economy. The repo rate, that's the gas. It's the interest rate banks pay when they borrow money from the RBI. So if the RBI lowers this rate, borrowing becomes cheaper for banks, and they're more likely to lend money to you and me, which, you guessed it, fuels growth. On the other hand, the reverse repo rate is the brake. It's the interest banks get if they park their extra cash with the RBI. A higher rate here makes it tempting for banks to just save their money with the RBI instead of lending it out, which helps slow the economy down to fight inflation. So, just to put a number on it, the current repo rate is sitting at 5.25%. This means when you hear on the news that the RBI hiked the repo rate, you know that borrowing just got more expensive for your bank, and pretty soon it's going to get more expensive for you too. And on the flip side, we have the reverse repo rate at 3.35%. This little number has a big say in whether banks decide to lend out their spare cash or just play it safe and park it with the central bank. It's all part of that constant balancing act.
But, what happens when things don't go as planned? What if a bank suddenly has a major cash shortage, what we call a liquidity crunch? Well, that's when the RBI deploys its emergency safety nets.
The first line of defense here is the Marginal Standing Facility, or MSF. Just think of it as an emergency overnight loan. It's for banks that are in a real bind and need cash right now to meet their daily commitments. It's basically the lender of last resort. And you can bet the RBI doesn't want banks using this emergency fund like a regular credit card. That's why the MSF rate is always higher than the repo rate. Right now, it's 5.50%. It's a lifeline for sure, but it's an expensive one, so banks only use it when they absolutely have to. Then we have the bank rate. While the MSF is for those overnight panics, this rate is for longer-term loans from the RBI. But it has another really important job. It's also a penalty rate. So if a bank breaks the rules, like not keeping enough money in reserve, the fine it has to pay is tied directly to this bank rate. Speaking of rules, let's talk about the big ones. These are the absolute, non-negotiable requirements that are in place to make sure our entire banking system is safe, secure, and trustworthy. Let's make this super simple. Imagine you walk into your bank and you deposit 100 rupees. Does the bank just turn around and lend that entire 100 rupees to someone else? Not quite. So the very first thing that happens is something called the cash reserve ratio, or CRR. Right off the bat, out of your 100 rupees, your bank has to send 4.5 rupees straight to the RBI. This money just sits there earning zero interest. It's a pure safety deposit. But wait, there's more. Next up is the statutory liquidity ratio, or SLR. On top of that 4.5 rupees, the bank has to take another 18 rupees from your deposit and keep it with itself. But, and this is key, it has to be in super safe, easy-to-sell assets, like gold or government bonds. So, let's do the math. Out of your 100 rupee deposit, a total of 22.5 rupees is immediately locked away for safety before the bank can even think about lending out the rest.
This combination of CRR and SLR is really the bedrock of our banking system stability. It's what ensures banks can always give you your money back when you ask for it.
All right, now for the part you've been waiting for. Why does any of this stuff actually matter to you? How do all these high-level rates and rules actually hit your wallet?
Well, it's a pretty direct chain reaction. Step 1. The RBI tweaks a key rate, let's say the repo rate. Step 2. This instantly changes the cost of borrowing for every bank in the country. Step 3. To protect their own profits, banks pass that change right on to us, their customers. And Step 4. Just like that, the EMI on your home loan, your car loan, or your personal loan goes either up or down. It's a direct ripple effect.
And please, don't underestimate these seemingly small changes. A tiny adjustment of, say, 0.25% by the RBI might not sound like a big deal. But when you spread that over a 15 or 20-year home loan, we're talking about a difference of thousands, maybe even lakhs of rupees. It has a real, tangible impact on your long-term finances.
So you see, the RBI isn't some far-off abstract entity. It's the active manager of our economy, and its decisions create waves that wash right up into your bank account. Now that you understand how the toolkit works, the gas pedal, the brake, the emergency lifelines, and the safety rules, you can appreciate the tough spot the RBI is always in. Should the next move be to slam the brakes to fight rising prices, or hit the gas to create jobs and spur growth? It's a huge decision, and the answer affects all of us.